Aggressive sell-off across global markets this morning with the UK's FTSE 100 index down over 100 points. The DAX in Germany is off around about 163 points, while the Euro Stoxx 50 index is lower by 52 points. In the commodities space, gold is off by 61 points. That's the same across all precious metals and oil prices. In the peripheral bond markets, Italian and Spanish bond yields have spiked. Core government bonds are also lower, with the German Bunds and gilt on the back foot. And at the same time, in the currency space, the euro has taken a leg lower, around to that 132 level. Sterling's taken a bit of a beating, and the dollar is unsurprisingly the only winner in the FX market. Good morning, I'm Ishaq, Siddiqi, and welcome to your daily market bite. I'm going to give you a quick wrap up of what's going on in financial markets today. So obviously the big news is the Federal Reserve's press conference, with markets absorbing Ben Bernanke's commentary and digesting it appropriately according to what's going on and what it means for risk assets and what it means for global financial markets for the next few months. Now, Ben Bernanke, chief of the Federal Reserve, yesterday said in a press conference that the Fed has laid out a plan to reduce the pace of buying asset purchases by the end of 2013. So he's given a timeline there, and at the same time he has suggested that the Federal Reserve will look to end quantitative easing by mid-2014. So as I said, there's a timeline now in place, something that was very elusive beforehand, which worried the markets. Now, Ben Bernanke is basing his reduction of QE and a halt of QE by the end of by mid-2014 on the basis that he believes the US economy is improving, that the jobless rate, the unemployment rate, will edge down below 7% by mid-2014, which would be an appropriate level for the Fed to start unwinding and looking to end the program. At the same time, he has upgraded his growth forecast for the US economy for 2014, so generally a bit more optimistic about where the US is going in the year ahead. So now we have this 12-month time frame in place. The real worry in the market right now is the Fed overconfident about this? Are they going to, through this plan, are we seeing an unwinding of quantitative easing too soon? And at the same time, risk assets are responding due to the fact that we are now going to see reduced liquidity in the marketplace up until the Fed starts its process. That's very worrying for investors, as they have to adjust their risk profiles and their portfolios according to what the Fed is doing with monetary policy. And when it comes to what this means for the US economy on the whole, it is a slight positive in the sense that there is a silver lining. The Fed do believe that the US economy is improving. It's going to be very much dependent on economic data in the months ahead. If we continue seeing strong economic data, there's a chance that unwinding of QE could be come forward. If we see a de-escalation of economic growth in the US and not an expansion as the Fed predicts, then we will see the Fed commit to its year-end target or possibly even push it back further. So this is very much data dependent. Investors know that, but that doesn't change the fact that we now have a confirmed date by the Federal Reserve to withdraw stimulus and to eventually end the program, which is inevitable. It had to happen, and investors are mostly responding to the fact that the Fed has now said it, and now for the months ahead we're just going to see a very turbulent time with volatility spiking across the board. Now, at the same time, investors are also contending with a slowdown in Chinese manufacturing. The PMI manufacturing number from HSBC printed lower, below the 50 mark. 50 signals the point of contraction, so below 50 would be contraction, above 50 is expansion. So the Chinese manufacturing industry is now firmly in contraction mode, and that hit the Aussie dollar, and at the same time it weighed on commodity prices, and that's had a spillover effect to the mining sector in Europe, which is currently bearing the brunt of the losses in European trade. Now, We've had European PMIs out today. Again, we've seen the composite PMIs below the 50 mark. However, we have seen a slight rebound when it comes to Germany and France, the two core Eurozone nations, the powerhouses. Germany was a bit mixed, where we're seeing an uptick in services, but a slowdown in manufacturing, whereas in France actually recorded a better print for both services and manufacturing, so a bit of a silver lining in that. Positive in the sense that the European manufacturing and services industry is improving, but at the same time it is still in contraction mode. We have to see further data to suggest that we are going to see an improvement in the Eurozone economy before investors really get bullish on the Eurozone case. Now, turning to what's going on for the rest of the session, apart from the fact that the markets are going to stay very volatile given the Fed's latest commentary. We do have UK retail sales coming up, and we also have some data out of the US existing home sales and the weekly jobless claims number. Interestingly, we've had a report out from the Bank of England this morning, which has placed a lot of attention onto the UK banking sector. The BOE now have come out with this report where they see over £26 billion of capital shortfalls for 5 of the UK's biggest lenders. This includes Royal Bank of Scotland, Lloyds Banking Group and Barclays. HSBC and Santander have been excluded from this report. They've got a clean bill of health. When it comes to these banks in the UK that have capital shortfalls, the pressure now really is on the banks to start urging this and taking action to raise their capital buffers in order to remain solvent. And also at the same time we are digesting Chancellor Osborne in the UK, his annual Mansion House speech, in which he indicated that the government is looking to sell off its stake in Lloyds Banking Group, but didn't give a timeline, and he did on RBS suggest that it could be a good idea that we see a bad bank where toxic loans are kept versus a good bank, so a massive restructuring when it comes to RBS. Other than that, corporate news is still on the ground, so the US economic data is very much in focus, and I'll give you an update on how those indicators performed in tomorrow's morning bite. Thanks for watching. Cheers.